We continue to await a coming wall of bankruptcies and write-downs, still unfolding from the viral economic lockdowns and ongoing tepid consumer spending response. Collapsing commercial real estate write-downs and recent record debt levels amongst governments, corporates, and consumers essentially guarantees a coming realignment for more infinite QE and higher inflation to come. It appears the current consensus amongst many in the investing crowd is that much of the real underlying truth and painful repricing will finally begin in earnest following the U.S. election this fall 2020, looking outward into the first quarter of 2021, a time which many expect the proverbial stuff to start hitting the fan. More than 30 million U.S. citizens are out of work, and consumer spending remains off by magnitudes of where it had been for years, leading into this viral economic consolidation event. As we await current silver and gold price consolidations, following recent sharp valuation gains thus far in 2020, this week's SD Bullion Market Update, we're going to take a longer-term exercise in valuation history and look out towards the future using some basic assumptions. Hello, this is James Anderson for SDBullion.com. If you enjoy complimentary but deep analysis on where the silver and gold markets are and likely headed, make sure to smash the like button below so we can better share this information with other like-minded people. Let's start with the facts. Our precise future is mostly unknowable, but we can still reliably consider some historic past precedents and the rhyme of history, if you will, while also thinking through probabilities to better determine if and when someday we might actually sell some silver and gold bullion investments. Of course, we have for now nearly 5 decades running been living under a full fiat currency global monetary regime, and it's a proven fact that always maintaining a prudent percentage of one's liquid net worth in physical bullion makes common wealth protection sense under such circumstances. And given the recent viral fiat currency monetary base M0123 explosions of late, if you don't have any bullion allocations yet, get shopping. Most of us here have likely slowly and diligently acquired our current bullion and precious metal investment positions over many years and even decades. Yet this week, we're covering how there will likely come a day for you or your progeny when it will make sense to slowly but surely reallocate some capital by winding down some of our precious metal positions once they've revalued substantially higher from today's levels versus other currently overvalued asset classes. Typically, every financial market and/or asset class eventually gets its years in the sunshine, moving from severe undervaluation to fair value to eventual overvaluations. Contrarian bets on gold, silver, and other precious metals are no different. They will soon enough, in my opinion, move exponentially and revalue higher in a sharp turn upwards. On this channel, we've covered one of the key historic precedents to conservatively understand how much higher the official U.S. gold reserves need to climb to cover a conservative, often historically breached, threshold for re-solidifying confidence in the sovereign circulating currency of the land. We'll leave links on those 2 videos in the comments below if you somehow missed them, but for now, let's quickly hear the words of a highly creepy but intelligent investor who back in late 2010 had some insights on where gold was ultimately headed by the end of this post-World War II debt supercycle.
So you're drawing quite a bleak picture. You've talked about a deflationary environment. Is there anything that's safe? Any assets?
Well, this is a period of great uncertainty, so nothing is very safe.
Gold?
Well, gold is the only actual bull market currently. It just made a new high, I think, yesterday. And in the present circumstances, that may continue, although it will be very interesting to see whether there will be a decline in the next few weeks, because practically everything that makes a new high almost immediately afterwards reverses and disappoints the bulls. That's
for psychological reasons, you think?
No, I think it's the current situation. So it will be interesting to see. But I called gold the ultimate bubble, which means that it may be going higher, but it's certainly not safe, and it's not going to last forever.
If you were around investing in gold and silver back in 2010, you likely remember this comment by Soros at the World Economic Forum about gold being the ultimate bubble. And it shocked a lot of people and scared a lot of people about gold. And the price from there ran up another $600–700. But what Soros was getting at back in late 2010 was that gold's valuation mega run higher is the end of this entire process, the final, ultimate, last financial bubble of this debt supercycle. The precious metals on a historic basis are currently severely undervalued still versus stocks, bonds, and real estate, and we're going to go through a few long-term charts to prove just that. A lifelong skill in investing is, after you've acquired your position at much lower valuations, eventually have many others agree with you with their own capital. One must learn to identify and sell what is overvalued and perhaps reinvest those proceeds into undervalued investments that are on the eventual upswing to come. For example, this 100-year chart shows the U.S. stock market's S&P 500 index divided by the price of gold ongoing. In late 1979, Business Week magazine ran a title that essentially pronounced "The Death of Stocks." That was the famous contrarian signpost looking backwards to go long U.S. stocks for the next 2 decades. Here's another recent cover they ran, which basically yells, "Inflation is coming this decade into the next in a large way." If you stare at this chart and let your eyes go blurry for a second, an increasingly obvious three-wave pattern is clear on this 100-year chart. Once the high stock valuation waves of 1929, late 1960s, and early 2000s crashed, they tend to then rebound in a dead cat bounce formation, ultimately later to then be forced to roll over and bottom versus gold, no matter how much market intervention occurs along the way. For me, this chart screams the old 2011 spike low is going to get passed soon enough and will likely pass the 0.5 threshold before peak in increasing valuation of gold versus the S&P 500 index. Remember that this week the S&P 500 closed at 3,340. You can do the math in terms of where gold is likely headed respectively. Moving onwards to U.S. bonds and real interest rates throughout this full fiat Federal Reserve note era, using the old pre-1980 methodology for measuring current price inflation ongoing versus 5-year U.S. bond yields, we see the interest rates for the U.S. would have to be near 10% right now just to cover the current ongoing debasement of the fiat Federal Reserve note. We currently have a hard U.S. debt level of over $26 trillion, hence why we also have near 5,000-year low interest rates. It's for real reasons. You see, if we had 10% interest rates today, which is only about half of where they got to in 1980, the U.S. government would be paying out more than $2.6 trillion in hard debt interest payments and much more in underfunded programs like Social Security and government pensions, etc. Basically, all the taxes that the U.S. collects would go to simply paying interest on the ballooning debt. Not going to happen. Instead, what's more likely to happen is the supposed easiest way out. Tax more, MMT-like infinite QE to come, universal basic income with direct Fed coin accounts, never-ending further lies about the inflation rates, and ultimately devaluing this still dominant fiat reserve currency until geopolitically it makes more sense to move to a new monetary structure and order, a likely three-sphered multipolar global financial order. In the meantime, the gap that we see widening on this chart is rocket fuel to higher gold prices and a raging commodity bull with higher inflation to likely follow for years to come. I am 40 years old, and I don't expect to see positive real interest rates this decade, nor in the next. Final charts for our real estate interested stackers out there. Obviously, with current housing loan rates hitting record all-time low levels, there's been a recent flurry in U.S. home buying. I presume many of these buyers believe with increasing inflation to come, paying off their mortgage loans will be much easier as the years progress, so long as their income keeps up with the rising inflation rates. Here's where we are today, and the old 2011 spike low is going to get surpassed in the years to come. not simply in gold, but also in silver. I know you might doubt my confident statements here, but just have a look at the Australian housing market valued by gold at the moment. Not only has it gone from ultimate bubble, it is now widely coyoting past its old 2011 level, but it looks like someday, soon enough, 100 ounces of Australian Perth Mint gold coin will get you an average house down under. There are many, many more valuation factors, sentiment indicators, and systematic structural changes that are required before I even consider seriously selling off any of my physical precious metal positions. Certainly, we still have a long and exciting road higher ahead. And gold at $2K and silver below $50 an ounce should remain a solid store of value in the inflationary decades upcoming. That all said, decisions about when or if to sell any bullion are personal and unique to everyone. I do not profess to have a crystal ball, and no one can tell you the top of the coming mania price peaks. Nor can anyone tell you with absolute confidence what currency you're going to get paid in if you do decide to cash in some precious metals. But just as we acquired bullion diligently with patience over time, so too will I try to keep you all informed of my valuation insights ongoing. For no matter the reallocations to come, as bullion values rise versus other asset classes, my always maintaining a prudent position in bullion is a lifelong mandate. It is a mandate for foundational wealth to be passed on. That is all for this week. Stay tuned to the end of this video to see how high gold must be revalued to reach both 1934 and late 1970s thresholds. And take great care of yourself and those that you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.